Anything else then, I guess?
Otherwise, I'll hand it over to Bryce for some cap tables.
All right. So the lighting here is really bad. Let me see if this helps. Oh, my lamp's not plugging in here. I think that's probably better, right? So I got my whiteboard here. So we're going to be a little bit of instruction time here. So when you guys think about, first of all, what are the differences between, I want this to be interactive. Think about capitalization tables, ownership tables. What are the differences between common stock, or excuse me, what are some of the attributes of preferred stock relative to common stock? We'll do the Socratic style. Jacob, give me a reason here. What does preferred stock have that maybe common stockholders does not have? Do you know?
Can you hear me?
Yep.
You're my connection's really bad. You're breaking up. It's hard to hear.
Okay, is that better maybe? Can you hear me now?
No, Bryson, I think that Jacob doesn't have a very strong internet connection.
Okay.
Been able to see that by the screen captures we've got with him. Let's move that question maybe to Alex.
Alex, what do you got? So when you think of preferred stock, Alex, can you hear me okay?
Alex, we're unable to hear you. I'm going to, there we go.
Good now.
Yeah. What does preferred have relative to common stock? What are some of the attributes of preferred stock?
Like liquidation preference.
Very good, right? So in a liquidation scenario, they have a preference, hence the name preferred, over junior securities. In this case, it'd be common stock, right? Okay, good. What else? What are some other attributes?
Voting rights.
Voting rights. Potentially, they could have different voting rights, right? Okay. What else?
The cost
Dividend
associated
payout.
may be higher. Yeah.
Oh, go ahead.
What was that? Let's go. Logan, what did you say?
Dividend payout.
Dividend rights. Okay, perfect. Dividend rights. And what did you say, Britton?
I was saying the same thing, just a higher cost may be associated.
Okay. So you can't see my whiteboard, can you? You got that glare on it again. My scribble. So in all cases, right? Dividend rights, voting rights, liquidation preference. So those are the main attributes. There could be some other things, and other features we'll talk about. But the reason why it's called preferred is because it has a preference on dividends before common shareholders, and it has a preference on liquidation. So as a claim to the assets of the company before anybody else, or before any other security or interest more junior to it, right? And so you've all done this through the capital stack, right? You have senior debt here, right? You have junior debt, right? You may have mezzanine, you have preferred, and then you have common stock. And again, I don't know if you can see that very well or not, right? And so these are the various, does that come in backwards? It does come in backwards,
No, we can see it well.
Okay. And so, right, as you think about risk, right? Risk, right? The higher risk is down here. So risk goes up as you go down the capital stack, and same thing with return, right? And so the correlation, so your upside obviously is in your common stock, your debt instruments, there's a stated coupon or stated interest rate, and so your risk is captured, it's fixed, hence the name fixed income, right? Whereas your preferred and your common stocks have greater upside. Preferred has less risk, but it still has less risk relative to common, but more risk relative to your debt. So when we think about value, a lot of times in valuation, we're valuing common stock. And the whole name of backsolve that Rick asked about, you know, what is backsolve, and that Michael explained, oftentimes venture investors and financial buyers are investing in preferred stock. And so we're imputing the value of equity, of ownership in the business based on a preferred stock financing. But because of these added features, there's a discrepancy in value between those two. Common stock is worth less because they don't have a preference in liquidation. They don't have a preference in dividend, and depending on the features of the voting rights. So I wanted to walk through here. I'm going to erase this real quick. And I know we're kind of pushing up against the clock. Can I go 10 or 15 minutes past our commitment time here, Rick, or do we have another commitment the team has to get to?
No, we're good. In fact, we're trying to be more respectful of your time, so that would be great.
Okay. Are you guys familiar with West Coast terms on venture investing?
They would
Have you ever
not.
heard that term? Shake your head no if you've never heard it. Shake your head yes if you have heard it. Okay. So venture investing, again, make sure I get my right markers here, right? Preferred stock typically has, I'm going to call these West Coast terms, a 1x liquidation preference to its original issue price. Okay, so if the preferred stock is priced at $1.50 a share, its liquidation preference is going to be 1 times that amount. It'll be $1.50. Meaning, before anybody common, any junior security to this preferred stock gets any distribution or liquidation in a sale or in a liquidation of the business, I, the preferred stockholder, has a right to $1.50. There are also conversion rights, meaning the preferred stock can convert to common stock at a certain ratio, and typically that's 1-to-1. 1 share of preferred will convert into 1 share of common stock. And then there's another feature called participation. Generally, West Coast terms means it's non-participating. It does not participate with common stock, meaning you can either, you the shareholder can either receive your 1x liquidation preference, or you can forego that liquidation preference and convert to common stock. It's not an and. If it is participating, then you get your original issue price of $1.50, and any other distribution past that $1.50, you can also participate in. So why is that important? Let me show you how this works. And maybe you've seen dividend or payout profiles based on a capital stack. If you have, great. If you haven't, this is awesome, I think. So let's say our preferred stock there's a company here, they have 1 share of preferred stock, 1 share of preferred stock with $1 original issue price that converts 1-to-1, that is non-participating, okay? In the capitalization table, we also have 1 share of common stock, okay? And so if I draw what the payout profile of this company looks like to this shareholder, this capitalization table. If this is my company value on the x-axis, and this is my price per share, right? And this is just dollars, 1, 2, 3, 4, 5, and this is 1, 2, 3, 4, 5, right? The first dollar in a liquidation scenario goes to whom?
Preferred.
Preferred shareholders, right? We have a liquidation preference of 1 times my original issue price. My liq pref is 1x, right? So the first dollar goes to my preferred shareholders. And anything from 0 to 1 goes here. The company sells for $1. Who does it go to? It goes to my preferred shareholders. That value is $1 per share. Who gets the next dollar?
Common stock?
My common shareholder does, right? Common stock. Okay? So if this sells for $2 today, right? $1 goes to a preferred shareholder, hence it stays $1 per share. $1 goes to my common shareholder. Okay? Now where does the next dollar go? it sells for $3. Who gets the $3? How's that split up? Guess what? It's going to go 50-50 to my preferred and my common stock shareholder, my common stock class. Okay? And at $4, it'll be $2 each, right? And so this line goes forever this way, right? So at any time this company sells for less than $2, there's greater value in my preferred stock. Anything above $2, the preferred shareholders will elect to forego their original issue, their liquidation preference, and convert to common stock and receive proceeds as if they were common stock. This is non-participating preferred stock. Okay?
And
So
did
the
everybody pin Bryson's video? Because if you pin it and it is big, then you see the two different colors that he's using and for the two different share classes, which...
Okay, so how would this change if it were participating preferred? Okay. So let's make it participating. Non-participating, this should be participation, right? And let's make it participating. So again, the first dollar is going to go to my preferred shareholder because I have a 1x liquidation preference. Okay. Now the next dollar, where does the next dollar go? It's actually going to be split 50-50 between common shareholders and preferred shareholders. Why? Because my preferred shareholder participates as if it were a common shareholder. And so the next dollar gets 50 cents goes to common, and 50 cents goes to my preferred. Okay? Where does the next dollar go? 50 cents to my preferred shareholder and 50 cents to my common shareholder. And so what happens? And then the next dollar, so on and so forth, right? And forever. So this is important. If you look at this, the value of participating preferred is always greater than the value of common stock. Always, always, always. And the preferred shareholder will never give up their liquidation preference to convert to common stock. Why? Because they already have that feature. They're already acting as if they are common stock because that's a participating preferred stock. Okay? And so you can think about this capitalization table, and you can have an infinite amount of permutations here, right? And of scenarios. This original issue price could be $2. This conversion ratio, instead of converting 1-to-1, it could be 1 share of preferred converts to 2 shares of common stock. We could have preferred A is this, and we could have a preferred B, right? Could be a 1.5x liquidation preference at $1.37. That converts 1 to 1.667 that is non-participating. And so you have an infinite number of attributes and combinations of the entire share class. What drives this? It's a market. You economists out there, there's a market, right? And so if it's going to cost me as an entrepreneur more of my ownership in my company to raise the necessary funding and financing that I need, and somebody else is giving me an offer that's better, I'm going to go with the better offer, right? So there's nothing that regulates this per se, and there's securities law, but these commercial terms is nothing more than a marketplace. And so I like to think of this as there are entrepreneurial friendly terms and there are investor friendly terms. And it's not, absolutely definitive, but it's all relative. So if we were to draw a line and call this entrepreneurial terms and this is investor terms, right? Is a 1x liquidation preference better for the investor or the entrepreneur? Well, in isolation, it doesn't matter. But if you compare it to a 2x liquidation preference, right? A 1x liquidation preference is much more entrepreneurial friendly because they're only giving up 1 times the original issue price. A 2x liquidation preference is much more investor friendly because that investor now gets 2 times the money back before anything goes to somebody else, right? But relative to a half X liquidation preference, it actually would be like this, right? Same thing with your conversion rights, right? A 1-to-1 could be considered very entrepreneurial friendly relative to a 1-to-2. 1 share of preferred converts to 2 shares of common, right? That's much more investor friendly because now they own a greater percentage of the pie relative to here. But, you know, if you were to change these terms as well. Same thing with your participation rights, right? Non-participating is much more entrepreneurial friendly, whereas participating is much more investor friendly. And so these are the attributes to think about in an ownership table, and that changes the value of the securities in the whole entire capital stack. If the pie is fixed, right, you're valuing the enterprise and then you're valuing the equity, and the pie is fixed, these commercial terms are going to change how this pie is split up between the different equity holders. If there's participating, a 2x liquidation preference, and a 1-to-2 conversion, a big chunk of this pie is going to go to preferred versus common, right? Or at least relative to each other. If these commercial terms are, you know, a 1x liquidation preference, 1-to-1 conversion, non-participating, then maybe the pie is split a little bit more evenly between preferred shareholders and common shareholders. And if it's this, then obviously the balance is more in the common shareholders, the owner's favor, the entrepreneur's favor. So I'm going to push pause there. A little bit of my lecture for the day. I don't know if there are thoughts, questions, observations, inquiries. What do you guys got? John, Britton, Logan, Pat, Griffin, who we haven't heard from yet?
I've got a question for you. So in regards to the participating or non-participating, with regards to venture capital, do you feel like you see it more that the venture capital's investment is participating, or do you see that they end up usually getting a non-participating preferred share? Yeah,
the market today, very good question. The market today is definitely, they call it West Coast terms. Back in the 90s and the 80s, you know, when venture capital was first evolving as a financing industry, those on the West Coast prided themselves as being more entrepreneurial friendly terms. And so West Coast terms is 1x liquidation preference, 1-to-1 conversion, non-participating. So you saw it in Silicon Valley, in Seattle, in LA, up and down the West Coast, primarily Silicon Valley. Today, almost everybody migrates. That's the starting point, is to West Coast terms, even in the East Coast, in Boston, New York, Washington, D.C., Charlotte. You're going to see primarily venture funds and venture investors and entrepreneurs start at West Coast terms. Now, again, it's a market. So what drives these terms? If somebody or if a company is in dire need of financing and it's a risky investment, the investors may want additional protections and therefore require a higher liquidation preference or a higher conversion or different participation rights or different valuation post-money and pre-money values as well. We didn't talk about pre-money and post-money, but nevertheless, there's a long way, Logan, to answer your question. Clearly that today in venture, we see West Coast terms. Probably 95% of all deals, I would say, are West Coast terms. Where I see participation, non-participation is in private equity, with a little bit later stage, and that still is only 5 to 10% of the time.
Okay, thank you.
Yep.
In terms of the underlying value and how these impact that value, would it be related to the like fully diluted shares outstanding and how that impacts the pre and post money? Or are there other factors there as well?
Yeah. So there's a couple thoughts there, I guess. It's a long-winded question. And if Rick, when I went to business school, my finance professor, his answers in finance is always, it depends. So it's never yes, it's never no, it all depends, right? And so your question is, how does this impact value? When we perform a back solve, for example, there's a couple of ways to look at this. When we're trying to value common stock, clearly the attributes of preferred stock is going to drive the value of the enterprise, the implied value of the enterprise, and therefore the value allocable to common stock. So that's really what drives it. And we typically model off of primary shares outstanding, not fully diluted cap tables. So we are not valuing the option pool. Most venture investors think of it on a fully diluted basis. We generally think of it on a primary issued basis, not on a fully diluted basis. So when we're backing into it, these attributes clearly reflect that. Now, when you're fundraising and you're an entrepreneur, and also the venture investors typically think of pre-money on a fully diluted basis, and oftentimes entrepreneurs get really fixated on my pre-money has to be, $80 million, it has to be $150 million. Well, if the investor does not agree with that pre-money value, they can still agree to that, but then adjust these other commercial terms to help protect them because they believe the price is, quote, too high, right? They may, I'll agree, fine, we'll agree to a valuation of $150 million, but I want a 1.5x liquidation preference because I think that is an overvalued statement. So the valuation on the company itself is, quote, wrong, not right or wrong, but they didn't agree to that, but they agreed to the valuation contingent on some of the attributes in the stock contract.
Great, thank you.
I hope that answered your question. I don't know if I answered it now or Britton, but it gives you a little bit of insight in the way we're thinking about it.
Yeah, thank you.
Well, that's a very different set of insights and concepts than we've dealt with as we've addressed cap tables. We've been more focused on dilution, pre and post, and such, and it's spent precious little time on participation. So, Bryson, thank you for doing that. That was very worthwhile.
Yeah, and so I would say you can go to some tools, right? And you can just imagine what the payout profile of this looks like and how it changes. And I teach a venture capital investing class down at UVU, and we spend a day or so on this and drawing different payout profiles. If there's a Series A, Series B, and a Series C in common stock, and you get the spaghetti lines going here, and you can sit back and go, wow, if I were to sell for $6 or $8 or $10. This share class is clearly the most valuable share class. This is the least valuable, and here's how they interact with each other. It's pretty cool.
Well, very good. Well, gentlemen, you've been extraordinarily generous with your time, and we know you've got a couple of things going on. I do have one final question that I'd like to pose because I think it'd just be interesting for all of us to hear your responses. And Bryson, this might be more focused to you than even Michael. Obviously, we're dealing with a little bit of uncertainty. You might have noticed that, and I'm afraid to look at what the market might be doing today, and just because I'm getting tired of seeing what's taking place. But that uncertainty is affecting virtually every facet of our lives at this point. What kinds of changes do you see, or are you able to see clearly enough yet? Changes that are going to affect you and how you run your business as a function of the environment we find ourselves in?
Yeah, I think from a human interaction standpoint, it will change tremendously. I think these types of interactions that we're doing right now will be much more frequent. They were frequent before, but I think it may even be a little bit of the new norm. Instead of meeting people in person, which in my business, that's super important to have the human touch, that may be less welcomed as we're changing this new, infectious disease world. So I think that's going to change. I think from a valuation and technical standpoint, we need to give a lot of thought into what is our opinion of the market today. Michael talked about multiples. So are we in a depressed situation only temporarily? And in 2, 3, 4, 5, 6 years, we're out of this? How does that feed into our analysis? Volatility is another function in our calculations on various discounts for marketability and option pricing models. And so how do we think about volatility in this time of extreme high volatility, and how do we make adjustments there? So I think that's my long answer is I think the interactions are going to change tremendously between professionals and the marketplace through technology. With our employees, it has changed, and I think that will continue to change. People will be more accustomed to remote working, whereas it's shifted over the last 5 years that direction. This has accelerated that. And so if Michael, if you all coming out of college, this year, next year, the following year, have a desire to live in a certain city, I think employers will be more open to that rather than having you in their centralized campuses, if you will. So I think there's a lot of factors that have changed our lives and will continue to change our lives because of what we're experiencing in the last couple of weeks.
Michael, anything you'd like to add to that?
I think that covers it. Nothing came to my mind that I would add here.
Very good. Well, class, anything that you might like to ask in a parting question here before we let these two sign off?
Yeah, I have a quick question real quick with Michael in regards to multiples. Is there a minimum amount of comparable multiples you guys like to have at the firm in order to feel like you give the most accurate valuation, or is it kind of more case by case?
It depends. I think generally speaking, I think the more multiples or the more good comps, the better, right? I don't think you want more just for the quantity's sake. They still need to be good comps, and especially good comparable companies. And the one thing that would override kind of that notion of, hey, the more the better, is if you have a pure play comp. If you have one that just is is the same company more or less, just further down the road and publicly traded, then I think you can have just a handful. As Bryson mentioned earlier, I think the comparable companies also, in addition to the multiples, we also pull volatilities from them. And so that's another reason why we like to have a good, 5 to 10, ideally, 7. I think 7 to 10 is a good set where, we feel comfortable that the volatility reflects kind of a good amount. But yeah, I think the more the better, with the exception of, hey, if there's one that's really the exact same, then you can go lower than 5 maybe, or be around 5. I don't know. Do you want to add to that?
Yeah, there's no secret sauce per se, but Michael characterized it right. It's nice to have more than one data point. But at the same time, there may be one comp that is really, really, really good. And so you can, demonstrate to the readers that you've looked at the entire market, but believe this is most representative and therefore relying on that one. So it's really I think a question of how you're positioning your argument in your report. But it's also challenging when you have a company that is entering a new market altogether. This does not exist, right? And so there is no good comp. So you need to look at various angles of the industry and the market on how you as a potential buyer or / seller would value this business. So that's always a fun exercise too. But there's no secret. It has to be at least 5 comps or at least 2 or at least 10. It's more of what makes the most sense given the situation.
Okay, thank you very much.
Well, very good. Gentlemen, again, you've been terribly generous with your time, and you're both great friends to our program. Michael, you're part of our DNA, of course. But thank you for spending the time with us today. We're very grateful.
Thank you.
Well, glad we had it. Sorry we couldn't host you in our office or even do a virtual tour for that matter. But maybe another time you're welcome to come by when the office is back open on Pleasant Grove Boulevard and stop in and say hello. Or next time, Rick, we'll get the crew in the office and spend some more time together.
Very good.